What was it like the first day when you were an intern on the floor of the exchange?
I actually, before I walked onto the stock exchange floor, I never thought about finance. It wasn't something I wanted to do. But those first minutes, the first 15 minutes, I knew it was what I wanted to do with my life. I loved it. I loved the pace. And I love the energy, and I love what capitalism delivers for this country. And I think that's what we should be talking about, because I think that's where we need a little bit of a tune-up.
Do you think anyone is defending capitalism at this conference?
Well, no, and that's the point. I think what I'm hearing at this conference is we have to tell our stories better, and I think capitalism is not immune from that, right? Capitalism has been the engine that has been the growth of the, really fueling the growth of the United States, but it needs a tune-up. We need to make sure that the American dream is a story of shared success. And so we got to get companies out from private to public sooner so that others can share in their wealth creation. And we need to talk about the good that those companies are doing by creating jobs and giving back to their communities.
One of the great voices of the NYSE is a guy named Ken Polcari. He's been great, loyal, visible, smart on the markets. Great. He and I remember another time. Is the New York Stock Exchange of today anything like what you knew as an intern, and where's it going to be in 5 years?
Yeah, we kept the best parts of the New York Stock Exchange, and we brought together modernization where we could automate the parts that really just should be automated. And so we really believe strongly that the combination of people and technology is so much more powerful.
Are you keeping Arthur Levitt happy with best price?
Yes, yes.
Explain that for our audience. Folks on radio and television, this is wicked important. You hear Arthur Levitt, the former chairman of the SEC, with us on Bloomberg Surveillance, and he's always talking about the execution. Explain why the execution now is different than before Ken Polcari had a beard.
One of the things that you want to make sure is that when somebody wants to buy or sell a stock, they can go out and see what is the value. And nothing values a company better than the public markets. But price is an important part of that. And so the exchanges are the ones that set that price. And even though market trading has changed and 40% of the market is trading in dark and not contributing to that price, they're actually taking those prices that the exchange is set to determine where to trade. And those are the same exact prices that a retail investor logging into their Fidelity, E-Trade, Ameritrade.
You just slipped through trading in the dark.
Yeah.
You trade in the dark?
What is trading in the dark? That's jargon. We don't do jargon here.
So what that is if you are showing your prices to the world to see, so that when someone logs into their online trading account or calls their broker on their Bloomberg terminal and they get their prices, their Bloomberg terminal is showing the best price in the market.
Stacey, you're making the argument that companies should stop staying in private markets for so long and come public.
Yes.
A lot of people would understand that argument coming from you. Why? And why are direct listings going to be such an important part of this process? So
the two great questions. The first one is why should they be public sooner? And there are a lot of conversations around why they're staying private longer. And you can talk about that. It's capital, it's regulation, it's all these things. But with the downsides to the fact that they're staying private means there's less discipline and governance in companies, which at a much larger company that's much more impactful. There's less clarity around valuation. So are these companies worth what the private markets are saying? Or do you need the wisdom and the disclosures and transparency of the public markets to determine that? And it's creating a bifurcation of wealth.
Let's talk about pressure, the pressure on you guys at the moment. We've had the likes of Larry Fink of BlackRock talk about leaning on the active management world to lean out of some companies, let's say, in coal. The pressure really is going to have to be put on the index providers to say to them, you need to get these companies out of the index. That's going to make the most difference. The pressure is also going to be on the exchanges. Why allow these companies to list on your exchange?
I think it's really important to make sure that investors have access to opportunities and the right to choose. And so by putting them on exchanges and giving them information about their disclosures is helpful for they can make informed decisions. I think it's really important to recognize what the conversations I've been having here in Davos over the past few days are from many CEOs who are saying we've been doing all of the work around ESG already because it's important to our employees. It's important to our customers that we take a stand on these issues, even more so than their investors.
So, Stacey, let me ask you this, because I imagine it's come up multiple times, not just at this conference, but over the last few months, maybe the last few years as well. You have minimum standards to be listed on the New York Stock Exchange. Minimum market cap, minimum amount of shareholders as well. Why not have ESG as part of that?
Because our standards are very focused on investor protections. And if those companies stay private, the conversations we're having are really connected, right? If we put so many standards around requirements for companies to be public, they have alternatives. It's a different dynamic than it was years ago when you actually had to come to the public markets to get money. Because there is money available in the private market space, we don't want investors to be denied those opportunities entirely.
This is not your remit. but I want your opinion on this because it's important. Faro has just recovered from the shock of losing that much money on his 8,000 shares of Uber that he bought.
Don't listen to this.
How do you respond when on your floor they do the song and dance of an IPO or even a secondary, but particularly initial public offerings, and they come out and they do the whole modern media dance and the thing goes down X%? That's not good for the brand, is it?
I think we should keep in mind that in a large IPO like that, they sold $8 billion worth of stock, and it opened at a price and stayed right there. Now, over time, investors were reacting to the valuation of companies, and as companies go public,
your job is to get it open in the early minutes
and to make sure that investors have the information.
Did they have the information on those
transactions? Yes, and you'll see it's a great example of private valuations versus public valuations, and so we need to actually make sure companies get out. And this shift, because they don't need capital, is actually why the direct listing was an innovation that we delivered this year, because it's actually not about raising money. It's about, in those cases.
Stacey, you're nailing. There's a private valuation. They go public in selected stocks. Tank. Whose responsibility is that? It's not you. Who is it? Who's responsible?
I think investors are asking
pricing?
questions that they weren't asking before, and I think that's what you're going to see in 2020, is that investors are asking about profitability and valuations. And when you have limited people participating in the private space, you're limiting access to opportunity, and you're also limiting access to information.